Good morning, my world building fam. I'm always happy to be here to have a chit chat with you guys. Thank you for joining us. This episode I know is long overdue, but we're here with it. Better late than never. Thank you again for joining us, and let's go straight into the topic that we're discussing today. And what are we discussing today? Today we're going to be learning and sharing together on 5 safe investment options for beginner investors. And as a bonus, at the end, I'm going to give you one cheat code that is going to help you to get the best out of these 5 investment options. So make sure you stick around to the end for that cheat code. And to go straight into it, first of all, I'm going to start with why I'm placing an emphasis on safe investment options. And what I've always said is, as a beginner investor, the most important thing for you may not necessarily be the quantity of your return, but the preservation of your capital, which is, if I invest 100,000 in this business, am I sure that in addition to extra, I would even have my 100,000 at the end of the investment? So that first is important. And then how regular your returns are coming is also important, because when a beginner investor just starts investing, it's good for them that they are seeing, it's good for you to be seeing how your money is growing, either on a daily basis or on a monthly basis. What that does for you is that it helps you to have confidence in the concept of investment. Unlike if you go put your 100,000 in something that is not safe, that is very high risk, and first of all, the day you put 100,000, the next day your money has crashed to 20,000, you're going to have a tendency to be afraid and say, maybe I for don't use my money by week or something like that. So as a beginner in investment, your focus should be on safe options that preserve your capital and give you a bit of fixed returns, or returns that are predictable for a start. So what are these options? And the very first option is quite unpopular, but is high yield savings accounts. High yield savings accounts are low effort. You don't need to go and fill one investment certificate somewhere. It operates just like your normal savings account with your bank. However, they pay you a bit of a higher interest than a regular savings account. So you save some money at the end of every month, you get a certain amount as interest. Usually there are conditions to operating a high yield savings account, and the most common condition is that you cannot withdraw more than 3 times in a month from that account. So because you've dedicated that account to be for savings, you're just going to put your money there. Occasionally you have an emergency, you can take some money from there, but it should not be more than 3 times in a month for you to get the agreed interest rate. Those interest rates can vary, usually from like 4%, 6% per annum, and things like that. So that is number one, high yield savings accounts. Ask your bank for it. They call it all sorts of names, but a high yield savings account is what many of them call it. Now, the second safe investment option that you can invest in is treasury bills. Treasury bills, in layman terms, are a way to borrow your government money or lend money to the government. Basically, the government is taking a loan from you and they're going to pay you back later. The good part of treasury bills is that the return on that investment, or the interest that they are paying you on that loan, you get it on the day that you invest. So treasury bills are traded at what is called a discount. So if you invest 100,000 today and your return is going to be 9,000, you get that 9,000 on the day you are investing. So you technically give them 91,000, and then you get your capital back at the end of the investment. Now there are different tenures for treasury bills. It could be 90 days, 182 days, or 1 year, things like that. But it's safe because you are lending to the government, and as long as the government exists, you're going to get your money back. The other option is federal government bonds. It's similar to treasury bills in that you're lending to the government, but the difference is that the tenure is usually longer. But for FGN bonds, you can expect to see tenures of 1 year, 3 years, 5 years. And this one now, instead of getting your return upfront, you would get your return at different periods, because the tenure is long. Like I said, for example, you do a 5-year bond. Every time you're buying a bond, they will tell you how often they will pay the return, but usually they're either quarterly or twice in a year. So you do a 5-year bond, and within that 5 years, you would be getting returns every quarter or every twice in a year. and then at the end of the 5 years, you get your capital back. Again, they are safe because you're lending to the government, and as long as the government exists, you're likely going to get your money back. Now, so we've done high yield savings account, treasury bills, federal government bonds. The fourth option is mutual funds. Again, in layman terms, mutual funds is an investment house or a recognized investment company taking money from a ton of people, putting it together in one bucket and investing it in different kind of things based on their own judgment. Now, because they take the money from a lot of people and they invest, then when they get the returns, they share the returns among all the people. Now, those don't usually have fixed returns, but there's a fixed range, for example, on how much you can expect to get. And the reason why it is safe, so there are different types of mutual funds. Let me start with that. So there are equity mutual funds, money market mutual funds, there are dollar mutual funds, all kinds. But the safest option in this use case and for Naira investments is money market mutual funds. And the reason why they are safe is because, like I said, when the investment house, for example, Stanbic IBTC, collects the money from different people, they invest it in different things. And that's what determines like what kind of equity funds they invest in, like equity. We'll talk about all of those, but equities are more high risk. But money market mutual funds, they invest it in safer instruments like treasury bills that I mentioned before and a ton of other things. But because they invest it, the money market mutual funds, they invest it in safer instruments, it means that it is also safe for you to invest in a mutual fund. The difference is just that now you're not managing this by yourself, right? So now that is what number 4, money market mutual funds. They're also safe. They pay returns monthly, and the returns may not be so high, but then your capital is safe. The final one, last but not the least, is ETFs. ETFs are called exchange traded funds, and I'll tell you why they're in this category. A lot of beginners want to, because we see the hype about the stock market, you want to also get a piece of that cake, but you're confused because you've heard that the stock market is very risky. You can put 100,000 today and tomorrow you have 1,000. So how can you do it? How can you invest in the stock market without exposing yourself to the risk? I give a tomatoes example. You can either go into the market, buy tomatoes, bring it back home and start sorting it into the soft ones and the hard ones because you like the hard ones. Or you can hire a personal shopper to go to the market and tell them that you want only hard tomatoes. Because they are a personal shopper, they know where to find hard tomatoes, where to find soft tomatoes. They can even buy all kinds of tomatoes and sort it and give you only hard tomatoes because you have told them that you want hard tomatoes. That is what ETFs are. Because you do not know the market or how to pick stocks, there are companies who their job is investment, they analyze companies, so they put together what is called an ETF. The full meaning of ETF is exchange traded fund. So they pick all of the best performing companies in the stock market and put it in a bucket. And you, instead of going to the stock market to be checking for best performing companies, you invest in that ETF. And that way, you have passed the headache of selecting what stock is good. You've passed it to that investment house. And you can invest in an ETF. That way, you're still eating out of the pie of the stock market without being exposed to the risk that exists in the stock market. So ETFs are safe options for beginner investors to get value out of the stock market without exposing themselves to the high risk that is in the stock market. So now that we know all of the things that we should be investing in, which are high yield savings account, treasury bills, federal government bonds, money market mutual funds, and exchange traded funds, which again are called ETFs, where should you be buying these things? That brings us to the cheat code. There are different kind of people in the investment market. There are companies that are called security exchange companies. So the likes of Trade or proper like banks and investment companies. Companies like Trade, companies like Chapel Hill, Denham, companies like Stanbic IBTC. These people, the way that I will explain it is that they are direct sellers. They have their own licenses and are able to trade directly in the stock market. Now, there are other people that I will not call their names, but many of the popular fintechs, they do not have a broker license. So what that means is that they have to go through an intermediary to be able to help you trade all of these instruments, buy or invest in these instruments. Now, the difference between buying directly from a company and buying from a third party in quotes is that sometimes the speed of treating your investments might be slow, and sometimes, not all the time, but sometimes there are additional fees that are charged by these people because they are a third party and they are not trading directly. I learned this when I'd been investing for long, and that's when I also started paying attention to it. So, as much as possible, do your investments with companies who have their own broking licenses, registered security exchange companies. Apart from the fact that it's generally safer, you may likely then save yourself some money on fees, on speed of your transaction being processed, and things like that. Now, that cheat code has saved me a lot of money, especially on transaction fees. And I would advise you to also adopt that. I deliberately didn't call the name of your fintechs because let nobody come and drag me. But then companies that have their own broking licenses are best for this kind of investment. So that is really all for today. You can share any insights or questions you may have on any of these investment options, or if you have tried and you didn't get them, or even where to find them. For not for loyalty purposes, but I've been using Stanbic IBTC for quite some time for many of my trading, and I'm going to put my referral link in the description so you can follow it and do any of your investment that you want to do with them. Thank you, and see you in our next episode. Bye for now.